Hello, and welcome to this masterclass by Zillion about how to invest in real estate. If you have any questions, feel free to ask either on the Zoom call or on Twitter, and we'll be happy to answer all your questions. So, without further ado, let's jump in. So I'll be hosting this class. In the past, I've had a partner to discuss stocks, but for the real estate, I'll be the primary one talking. So, how to go about real estate investing? So, let's jump in. First of all, real quick introduction about me. I'm the co-founder and CEO of Zillion. We are a platform that helps you multiply your money through better financial decisions. And what do we offer in Zillion? We believe in Zillion based on more than a decade of research. We believe that there are 7 essential steps to reaching financial freedom, and the most critical is actually earning. That is the foundational step to achieving financial freedom in your lifetime. And second is saving. Stashing away more of your earnings will help you save more and actually then investing those savings. So these three, actually, I would say these are the fundamental steps, the fundamental ways to get to financial freedom. After that is spending. Managing spending is important, but it comes after you have increased your earnings, increased your savings, and invested those savings. And then borrowing the right amount, and having the right amount of leverage is super important, which we will discuss in this masterclass today. Because real estate is more or less all about borrowing and leveraging. Also, planning. How do you manage all of this? Money needs care and planning, and we'll talk. That's the sixth step in financial freedom, achieving financial freedom. And lastly, once you have done all of this and you've accumulated a decent amount of money, decent amount of wealth, then protecting everything is important. And we at Zillion help you on your journey to financial freedom by helping you along the way at each step of the way. And again, this is based on the research we have done over a decade, my personal research that I did even before I started to come up with this framework. Okay, and how exactly does Zillion help you do all this? First is we help you improve your 401k. If you are in the US, 401k is by far the best shot at achieving financial independence. So if it's, let's say, you're coming year end or beginning of the year, if you're thinking, hey, how should I improve my 401k? We have a product for that. We help you optimize your 401k to the minutest details. If you want to go on vacation next summer, is that on track? How is that vacation spent? Let's say it's $5,000. How is that going to impact your long-term goals? We have a product for that helps you track your financial independence goals. Should you buy a home or continue renting given the scenario of high interest rates? Well, we have a product for that. Also, should you save for emergencies? How much? People say 6 months. Some people say 12 months. We actually have a very scientific tool that helps you figure out how much you should actually save. Should you invest in stocks or real estate? Well, fortunately, we have tools for both. How much should you invest in stocks? How much should you invest in real estate? Is this the right investment decision or not? We have tools for all of that. And not just that, we went above and beyond for that to help you really take control of your financial life. One way we do that is by giving you your money score. What's money score? Money score is the better cousin, the wiser cousin of credit score. Credit score tells you how well you manage the money you borrow from banks or from mortgage companies. But what about the money that you don't borrow? Which for most of us, actually that's the bigger part of our financial lives. The money that we earn, the money that we invest, the money that we, that's saved. And Money Score captures all of that. So go to zillionapp.com and find your Money Score today. Also, we help you navigate debt. We all have debt, credit card to home to car loan to all that. Which one should you pay first if you have a little bit of extra money? Should you pay anything first at all? If you should you pay off any loan earlier or not? So we help you with that through our Debt Navigator product. And also, a lot of times, some of us don't just need tools, we need to talk to a human being. And Zillion provides that. We provide you excellent qualified mentors who you can set up video conversations, or just text them, email them, and say, hey, I have this question about whether it could be real estate or stocks or anything. And how do I do this? And our mentors will help you. And our goal is that you should be able to do all of this with less than 10 minutes of time investment per week. We know you are busy raising a family, working full time, and maybe both you and your spouse are working full time. You don't have time to think about finances day in, day out. We take care of that, but you just have to spend 10 minutes in a week on zillionapp.com to manage all of this. And there's much, much more. Feel free to go to our website. You can actually see our website. We have a lot of products. Some are paid products that you can use by logging in, but some are actually free products. If you want to see how the economy is doing, you can go take a look. And also we have a lot of articles to help you familiarize yourself with finance concepts that you may not otherwise be. But these are all the products we offer today. Great. Let's move on. So my real estate experience, here it is in a very succinct way. 2008 is when I first bought a real estate property investment. And it was not an investment, so to speak. It was our first home. We were renting, and I did some math in a spreadsheet. And I'm like, this seems like a good time to buy, because in 2008, the prices were going down, the interest rates were going up, and the economy was going down as well. And when I did the math, we were paying about $2,000 in rent, maybe $1,800. And we figured that we would pay about the same, but we would be able to afford a bigger home, a bigger place to raise our kids. Our family was growing at that time. So we bought a house in Boston, Massachusetts. It was a townhome. Also, I got an FHA loan. You only have to pay, today you only have to pay 3.5% down. At that point in time, it was 2.75% down payment. So literally we paid, the house was worth about $280,000, and we paid a $6,000-$7,000 down payment on it. It was actually really, really good deal for us. 7% interest, but we refinanced it over the next couple of years. And it was in move-in condition. We literally had to get our carpet cleaned and we moved in. The house was in pretty good condition. 2013 was the next venture I did. This was with a friend who is a realtor. And we bought a house in Northern Virginia, a townhome in Northern Virginia as a partnership. We put 10% down. I put 5%, he put 5%. And we got a loan at 4.5% interest rate at that point. And because my friend is a realtor, he had a great network, and he was able to manage everything. We will discuss this in detail further into our session. Also, we had steady renters. This is important. Buying real estate in a good location matters way, way more than just buying a good deal wherever you get. We'll discuss this as well. 2015, we moved from Boston to California, San Francisco Bay Area. And when we moved here, we sold our Boston home. But before that, we bought our home here in California, single family home, 3.5% interest rate, 7.1 adjustable rate mortgage. We put 20% down because the market was pretty hot. Without 20%, the offer was not going to be accepted. But it was a fixer-upper. We bought they say buy a shitty house in a great neighborhood. That's exactly what we did. We bought a house that looked really bad. Same family had lived in the house from when it was constructed in the late 50s until we bought it in 2015. So close to 60 something years, the same family lived. The house was in a bad shape, but we spent, I would say, high 5 figures, and we were able to move in, and the house looked new by the time we moved in. And then 2020, an opportunity presented itself. We bought a townhome in our neighborhood, and we put 20% down, 4.5% interest, 30-year fixed. And we put, the house needed some work. So we put about $10,000 to repair the house so that it was ready for to have renters. And we also did one thing that is unusual in this part of the in this part of California, which is most homes didn't have air conditioning. So we decided to put air conditioning, and that actually increased the desirability of the property. And we rented it out in summer of 2020, and same renters just have been renewing the lease 3.5 years now. And right now, I actually have formed a partnership, and I'm looking to buy real estate in San Francisco, downtown. The reason being, San Francisco, everybody is saying San Francisco is bad, and the best time to buy real estate is when the prices are low, and San Francisco prices have gone down quite a bit. And this time, actually, I'm thinking of buying an 8 to maybe a 4 to 20 unit rental. So, a bigger deal, but with a partnership, a price range up to $10 million, depending upon what kind of property we come up with. So this is my journey. And along this, I've refinanced a bunch of times, evaluated multiple properties, lost out on properties. So I've had a decent amount of experience in dealing with real estate. And I'm constantly evaluating, constantly looking in our neighborhood, wherever my friends live, to see if it makes sense to buy something there. Okay, before we jump into the specifics of real estate, I do want to give you an overview of how to think about investing in general, and how different investing choices actually are likely to perform. This is based on historical data, so please do take it with a grain of salt. But at the same time, history does repeat itself, especially in a country like America, where things do not change abruptly. For instance, savings accounts, long term, they give you about 1% return. CDs long term give you about 2% returns. Even though right now these savings account and CDs are giving very high returns, within the next 2 to 3 years, we are likely to go back down to these averages. Real estate, 4% returns on average over the long run, maybe even closer to 3.5%. So if you invest $1,000 in real estate, you can expect that to become $1,480 over 10-year period. And also keep in mind, real estate volatility overall is low. Yes, we had too much spike in prices 3 years ago, 2 years ago. Now the prices are coming down. 2008, 9, 10 prices actually came down. But overall, in the grand scheme of things, real estate is actually not very volatile. But it's also not very liquid. If you put money in real estate, you can't just sell it when you need it. It takes time. If it's rented out, you need to move the renters out, you need to stage the property, you need to sell it, settle it. It could be a 6-month process or even longer. But the risk is very low. Real estate, generally an appreciating asset in the long term. Short term, many things can happen. Also bonds, I'm not going to dwell too much, but something to keep in mind, the gold standard for investing is S&P 500. What do I mean by that? If you were to invest in real estate, and we'll we'll discuss it in detail in one of the following slides, but if you invest in anything, you should always compare it with, is this going to be a better investment as compared to if I were to invest this money in S&P 500 index fund? That should always be the standard by which you should measure everything else, every other investment. And my real estate investment, one property that we had bought in Northern Virginia 10 years ago, we sold it earlier this year. It returned about 17 to 18%. And I have a video, and I'll include the link to the video in this presentation so you can see it. So yeah, don't, this is, treat S&P 500 as the standard. Okay, and if you have a question that, if real estate only returns 4% and S&P returns 10%, why ever invest in real estate? Hold your horses. We'll talk about it. The key thing there is leverage. What do I mean by leverage? Leverage means you put 20%, bank puts 80%. This 4% appreciation becomes kind of 15 to 20% because of that. So that's why real estate works. Okay. One important thing, or I should say few important things, is not every investment is for everyone. For instance, until 2013, I did not think I wanted to invest in real estate. Why? First time I really started, saving a lot of money, me and my family, was around 2007-8 period. That's when, I started making enough money that we were saving enough. But at that time, I felt the best investment for me was buying stocks. 2009, 10, 11, 12, great time to buy stocks. So I bought a lot of stocks. But 2013 onwards, it seemed like stocks had appreciated a decent bunch. So I started thinking about diversifying and buying real estate. That's when I reached out to my friend. So keep that in mind. Why do you want to invest? For me, it was to diversify. I didn't want to keep all my money in stocks because most of my money at that time was in stocks, whether through 401k or ESPP or my brokerage account. So the idea was to buy another asset, hold it long term, and when one of the kids is ready to go to college, sell that. That's exactly what we have done. Also, think about what your strengths are, right? Different people have different strengths. For instance, I like to read a lot about economy, macro, micro, about the companies, about businesses. So stocks is natural to me. But at the same time, my wife and I, we like to go around our neighborhood for walks. Rather than going on trails or anything, we generally go through the neighborhood, and we kind of know our neighborhood better than anyone else. So that's our skill, and we know the neighborhood. The risk is super low, so that's our strength. Nobody knows the I would say 5 to 10 square mile area around our home better than we do. Which market to invest in, and I would actually narrow it down. I would say just invest in the market you know, or invest in the market one of your friend knows really well, someone who you trust. When and where to invest? Real estate is a long-term game. Like in real estate, 5 to 7 years is considered extremely short term. Okay, 10 plus years is medium term, 20 plus years is long term. So don't invest in real estate if you think you can't sit on that property for at least 10 years. Here's the risk and reward. Different forms of real estate investing: single family homes, multi-unit, commercial, REIT. I'm not going to cover this too much. REIT is real estate investment trust. Some of the big companies like I think CBRE and Boston Properties and those, you can just buy their stock, so to speak. They are exchange traded real estate investment trusts. You can buy, and they pay you dividend anywhere between 2 to 3% to some even 7% or so, and you can just enjoy that. The risk is low or medium for single family home. This is what I recommend for if you're just getting started. Just buy a single family home or maybe a town home in your neighborhood, in your town, the town you know, the neighborhood you know. The reward is also medium, right? I mean, risk and reward go hand in hand. The more risk you take, more reward you can expect. This investment horizon is short for let's say buying a townhome or a single family home. When in real estate, short means 5 to 7 years. Okay, nothing. Like, I'm not here to advocate flipping. If you have a full-time job, if you are raising a family, flipping may not be the right approach for you. Flipping is for professionals. If you are trying to do this as a hobby, as just a side gig, I do not recommend ultra short investments into real estate because it will suck all your time. Cap rate is how much you make divided by how much you paid. It's low, right? But it's a long-term play, and in long-term play, and it's also diversification. So again, multi-unit and all, you're taking a little more risk, but you have to spend a little more time as well, and your returns become better. But you have to stay invested for a long, long time. I would actually correct this one. This is actually REITs you can get in and out. It's actually pretty liquid. Cost and benefit, tangible costs, you have to pay down payment. Real estate is not cheap. So even before you buy real estate, you have to accumulate at least some down payment. And the The cheat code for buying real estate, if you haven't bought any real estate so far, the cheat code is you should buy, let's say, a 2, 3, or 4 unit property, get an FHA loan where you pay only 3.5% down, and rent out the second unit that you have. That way, somebody is helping you pay the mortgage, and you would end up likely paying less than 50% of the mortgage. The renters will pick up that. So that's a good way to do it. But overall, it does require down payment, setup cost, fixing, if you need to paint the property, if you need to change, replace a deck or something like that. Recurring costs. If your renters move out, the mortgage still needs to be paid. The insurance still needs to be paid. The bills need to be paid. So there is a recurring cost. And it is anywhere between 5 to 25% of the purchase price. And don't worry about this. We have actually built a product for you where you can see all of this, and we actually help you see what exactly is how much, what costs how much. So don't worry about that. Also, there are intangible costs. Average time, each property will consume 2 to 3 hours per month. Each property, okay? Now, if you add it up, 3 hours a month per property, you're looking at 1 week of investment in one property in a year. And that's if everything goes well, right? But when you buy, it's more. So keep that in mind. Let's say you have 3 or 4 properties. You're talking about 2 to 3, let's say 3 to 4 weeks of your time will go into that. Keep that in mind. Also, it's effort. You have to drive around, you have to call people, you have to, buy stuff, ship stuff. It's real work. You will come across, if you do it long enough, you will come across some not so desirable tenants, some unforeseen situations that might require you to go through some motions that you otherwise wouldn't in your regular day-to-day life. And your money is locked. When you put money in real estate, that 20% you put, you can say goodbye to that for at least 5 years, maybe even 10 years, potentially forever, until you sell the property. So keep that in mind. Your money is locked. It's not like a stock, right? You buy stocks, you can sell them anytime, or even REITs. When you buy a property, you can't do that. Benefits, monthly income. Once you know this game, how to play this game, and you get the skills, this can become a monthly income. But the bar is pretty high, and we'll talk about that. You can buy more. Let's say you bought a property, 5, 7 years ago. That equity is built up. You can take that equity out by doing a refinance, cash out refinance, and then you can buy another property with that, right? So you can kind of start building a bigger portfolio by that. Debt to income ratio. If you are a high income earner, this is your weapon. This is a great tool you have to increase your wealth. What does debt to income ratio mean? Let's say you and your spouse together make, let's just say, $200,000 per year. And let's say you already have a home, and you have some car loans and some, a couple other small loans. And let's say your monthly payments come out to be $4,000, say $5,000. If it's $5,000, then it's $60,000 per year, your monthly payments. And 60,000 divided by 200,000, now you're talking about 30%. And the bank will happily lend you money until you reach about 40%. Some banks even go to 50%. And if you can buy real estate with that extra debt to income ratio that's available to you, then it doesn't cost you anything, especially if the rent coming in is equal to the expenses. Then you basically can actually get the bank to pay for all of it. And we'll show you the math, how it works. Also, there is some intangible benefits. It is a pretty safe option, right? I mean, property rate prices in general, unless you live in some of the cities or towns that are on the decline. If you live in a area where the population is growing and the overall job market is growing, then you can buy it and kind of forget about it for the next 10, 15 years, and it will appreciate. And also, it's a sort of investment hedging, right? Putting all eggs in one basket is not ideal. This helps you distribute your eggs. There is tax benefits. Real estate works, one, because of leverage, two, because of taxes. US government actually makes it easier for you to buy real estate. And there are much bigger tax incentives to buying real estate than to a lot of other investments. So definitely that helps. And also, yeah, like you don't need specialized skills or anything like that. Right? Anybody can actually start investing. So there are no barriers to entry. Do's and don'ts. So the do's: buy something in a desirable macro location. If you want to buy in a town where the last automotive plant closed 2 years ago, and crime is going up, and the downtown is all boarded up, probably not a good thing. Buy in a desirable location. Having said that, you might question, why am I buying in San Francisco? San Francisco, despite all the gloom and doom talk, and despite some of the stores being boarded up in downtown, I think long term, San Francisco will bounce back. It is this beautiful city on the coast in California, hub of the tech revolution, like capital of AI innovation, two great universities right here in our neighborhood, and two other great universities within 70, 80 miles. So overall, just young people keep coming to San Francisco. So it is a desirable location. Commercial activity close by, a walkable property, walkable to shopping and other activities is always good. Growth potential, again, growing cities, positive cap rate. So overall, net income should be positive, and also get advice from experts, right? Especially if you're new, and we can help you. Go to Zillion. We have wonderful mentors who can help you and walk you through what to do, what not to do, and what lens to apply where. Don't buy properties that have existing major issues. And sometimes you don't know what those issues might be, so get professional inspections done. People who do this day in, day out, they know where to look, and they can tell you, hey, the baseboard has an issue, or there's termite problem, or there is a leak underneath this particular sink or this dishwasher, and it's going to cost you $3,000. So make sure you consult with an expert and get inspections done. Liability areas, anything that has a history, any previous chemical plant or any facility like that, stay away from that. There is a sweet spot in buying homes. For instance, a 3-bed, 2-bath, quite desirable. A lot of families want to rent that. Maybe 4-bed as well. You get to 6-bed, 7-bed, very, very few people would want to rent that kind of thing. So stay away from super big places. Poor micro location. You might be still in a good town, but if your property is right next to, let's say, a gas station that is frequented by commercial trucks, it's not going to be sitting well with the renters. So avoid those. Also, don't buy properties with all cash. I'm not a big fan of this because, again, if you buy all cash, you can only expect 4% returns over long term, which is way worse than S&P's 10% returns. Also, as I said in the beginning, leverage is what makes real estate worthwhile. So don't buy all cash. Okay, real estate investment growth. This is last, about 40-something years. And you can see, maybe even 50 years, you can see that overall real estate does go up a little, down a little. Well, in 2008, 9, 10 crisis, actually, the prices went up a lot, then came down a lot. But you can see the long-term trend is about 3 to 4%. This is my line. This is from the US government data, but this is my line. And the COVID caused a huge boom, and now it's coming down. So you can see that, and again, this line is different for different metros, slightly different, right? San Francisco is going to have a higher line than, say, Buffalo, and that's just understandable because different areas have slightly different dynamics. But overall, you can see real estate in the long term, like don't invest for less than 15, 20 years. In the long term, it will yield decent returns. Okay, for best real estate decisions, this is based on my experience and my conversations with a lot of great real estate investors. Invest in your local market or town. If you cannot find anything in your local market, let's say you live in a very expensive place, say LA or Boston or San Francisco, then find a partner in a non-local market. Like I found my partner, my friend, in Northern Virginia, which was much more affordable as compared to Boston. Focus on a desirable area and home plans. Anywhere where young families want to move in is always a great place to buy a house. Start with smaller single family or even townhomes. Invest in homes where you would want to live in. This is super critical because sometimes you actually want to move into that. I've had situations where I've known friends who bought a property that they were going to rent it out, but they thought that, oh, it actually makes sense for us to move into this property and either sell the one we are in right now or rent it out. So buy a house that you also might want to live in. Use professionals. You're going to need plumbers and electricians and, like a lot of people, masons, the gardeners. Build your network and have backups. Don't just know one painter, know 4. So you can call them and ask them for a price or ask them, their availability. Make quick decisions. Real estate is actually, nothing is static, and real estate is no different. If something is on market, it makes sense to make a decision quick. And the tools we have help you make quick decisions, and I'll show you right after this. Get unbiased perspectives from your spouse, your friends, other professionals, realtors, like, hey, what do you think? What do you think about that, right? So get that. Take calculated risks. Real estate overall is less risky as compared to other assets. So it's okay to take a little bit of risk there. Also create relationships with multiple vendors. Similar thing as professionals. And most importantly, do the math. Not every real estate deal is going to be great for you. But if your question is, how do I do the math? You are in luck because Zillion has the perfect tool for you. We have the real estate investment tool, and you can actually go to Zillion and click on real estate, and it's right here. And I've already done some math on some properties, and you can see I've done all this math, and some come up as, hey, this is a great deal or it's a bad deal. And you can see, so for instance, this one, this is where I did all the math, and it's as simple as, and I can show you right here. You can just say, hey, I'm thinking of buying a new property. Let's say the name of the property is Main Street Townhouse. Okay, and you can say, oh, this is actually in California. And the square footage is, let's say, 1,800. California doesn't have really humongous homes. And let's say it's at $850K. And I am planning to get a loan. I'm going to put 20% down, and the interest rates are at about 7.5%. I can rent it out for, let's say, $3,800. Oh, $3,800. So you can see we already are doing all this math. HOA fee about 10% of, that's typical for US. So we already put that, but you know what? This one actually is not bad, and it's only, let's say, $220 a month. Okay. Property taxes, California is 1%, but let's say this one is going to be 1.2% or maybe 1.3%. And now I'm getting a decent idea. Okay, insurance 0.35%, but actually I got a decent deal, and it's actually only $1,200. Closing costs 3%, and maybe the seller can pay me back 1%, so it's actually only 2%. And also maintenance and repairs is 10% off the rent. Also, I'm going to be managing this property on my own. When I do this, as soon as I do this, and I'm like, okay, analyze this deal for me, please. Within seconds, you will see that whether this deal makes sense or not. At 7.5% interest, this deal doesn't make sense for me. Okay, so this is what I meant by do the math. You should be doing this math for every property that you are looking at. Why? Because that's the most important thing when buying real estate. The math has to add up. Put all the numbers. You can play around with the numbers, right? If you're like, hey, I want to change a few things, sure, go in. You can go in and change whatever you want. You're like, you know what? The rent is going to be, I can actually get 4,000. How about that, right? And HOA fee, you know what? This is actually 130 per month. And property taxes are what they are. Insurance is what it is. And, maintenance and repairs. I know a good handyman, and he can actually do it for maybe 5% per year, right? Doesn't make any change. Let's take a look. And I made that change, and now it's saying it's still a bad deal. And you can see why, right? Because, so here's an important thing. What we do is we show you what is the annual cash inflow, rent, and some tax benefit. And we also show you what is the annual cash outflow, maintenance and repairs, mortgage, monthly payments, right? Vacancy. Sometimes you can't rent it out. Property taxes, HOA fee, and insurance. Okay. So when you look at all that, your annual cash inflow is 64,000. The cash outflow is 75,000. Your time investment, as I said, 40 hours a year, that has some value. We put it at $100. And you can see that overall, you are now at 21,000 in non-cash returns net. So if you add all this up, your overall return on this property is $11,000, cash plus non-cash. But if you were to invest this money, down payment plus closing costs, into S&P 500, you will make $18,000 per year. So this is not a good deal. This is what I meant when I said always compare with S&P 500. You should put this $187,000 into S&P 500 index fund and enjoy those returns, because this property is not worth the hassle. And if you want to see how it could become worth the hassle, you can change some numbers, play around with some numbers, and see for yourself. What if the interest rates come down, right? So for instance, interest rates come down to 6.5%. That usually is the biggest cost. Does it become palatable at that? And let's take a look. And now it's still not a great deal. And actually, I think once it comes down to about 5.7% or something like that, I think it's going to become a much more desirable place to be. So let's say 5.5%. And if you do 5.5, you can see, if I update this at 5.5%, if I were to make a guess, it's, see, at 5.5%, it flipped. It's now a good deal. And again, why is it a good deal? Because S&P 500, is going to give you $18,700, but now your monthly expenses have gone down because of the interest rates going down. So you are making slightly more on this. So this is how you should evaluate a property. We have made the math super duper easy. So just go in, create an account on Zillion, go to real estate, and you can start doing it. And this is what I've shown here. You will also see it in the presentation. But yeah, pretty straightforward: cash inflow, outflow, tax adjustments, everything. And based on that, we will tell you whether it's a good deal or not. The key thing is, will this deal be better than S&P 500 index fund or not? If not, don't buy this. If it will, buy it. And how would you know that? Through the Zillion product that I showed you. If you have any questions, feel free to ask. You can also reach out to me at gagan@zillion.co. That's my email. Or you can sign up for zillionapp.com, get 1 month free. You can analyze as many properties as you want. And you can also ask me questions on Zillion platform itself. I'm always willing and eager to answer questions from our customers about different things, whether it's real estate or stocks or what have you. And we also have very capable mentors who actually can help you, whether it's stocks or it's some of the modern cryptocurrencies or real estate or 401k, you name it, our mentors can help you with those. With that, we come to an end. Thank you so much for joining us, and I'll see you next week. We'll cover another very interesting area of personal finance next week. So please do join. Thursdays at 1 p.m. Pacific time is when we host our masterclasses. Please join us next time. Thank you so much.